In this video, I'm going to talk about journal entries. A journal is a chronological record of transactions, and you would record transactions here first. Any transactions you record here would be called a journal entry. And then once you record the transaction here, you would copy it over to the ledger. And this is organized by date, and we're going to use the same debit and credit rules that we would use for a ledger. So in my previous video, I talked about debit and credit rules, and I talked about a T account as an informal ledger, and we're going to be using that same information here in this video. And I just want to point out that if you're using a computer, a lot of times the journal entry will automatically post over to the ledger, whereas if you were doing this by hand, you would have to physically put the entries in the journal and then physically copy them over to the ledger. Okay, this is what a journal might look like if you're learning this out of a textbook. If you're looking at a journal in a computer program, it might just look a little different, but it should have some key pieces of information in it, such as the date, the account names, and the debit and credit. So let me just go over some of the pieces that you're going to see here in this journal. First, there's a journal page number at the top. You would have a date, the names of the accounts, and these are accounts from the chart of accounts. Those would be used here in the middle. You would put the exact name from the chart of accounts. And then you may or may not have explanations in each entry. It just depends on whether you're learning this in a class, whether your instructor has you put explanations, or if you're using a computer and doing your own accounting, you might put an explanation in the memo line or the description line. And then account numbers would go here. That's what this post reference column is for. These would be account numbers from the chart of accounts if you have them. You may or may not have account numbers. And then of course, any dollar amounts or currency amounts would go under the debit and credit columns. So you're going to want to line up your account name with either the debit amount or the credit amount. This is what a completed journal might look like. Notice that I have debits first on every entry. If you are learning in a class, you may or may not have an instructor who tells you to do this. And then you would have credits underneath and indented a little bit. And the reason you're doing this is for consistency. When you're doing things consistently, sometimes it can make things easier. It makes things more organized. And visually, it is easier to see whether something is a debit or credit if you know the debits are always first and then the credits are indented a little bit. And then the amounts, of course, will line up with the debit and credit. And then for the post reference column, I just put random account numbers. I had a project from teaching accounting many years ago, and I just used those account numbers. Now the explanation underneath each entry, I put in italics so it would set it apart visually so you could see that it was an explanation and not a debit or credit. But this just adds information to the entry. And of course, in real life, you might have customer names, you might have invoice numbers, you might have check numbers, and extra real information. But if you're learning out of a book, it's just going to be very generalized. And then we would copy the debits and credits over to the ledger. So you're not thinking about the information again at this point, you're just copying. It's easier to learn debits and credits using the T accounts, which is an informal ledger. So that's why I did that video first. But technically you would do the journal first and then copy over to the ledger. So this is just some information that's review from the last video. The ledger is the book holding all the accounts. Once you record in the journal, you copy over to the ledger. The T account is an informal ledger, and it's just a good way to learn debits and credits. And then debits and credits will be on the left and right. Debit is always on the left. Credit is always on the right. That is just a basic rule of accounting. And these represent increases and decreases to the accounts. And I talked in the last video about how you have to really just ignore what you think of when you think of debits and credits, because in accounting, they are just left side and right side. And these are the rules of debits and credits. So you'll need to know the account type that you are referring to or posting to. And then these rules will tell you whether a debit is an increase or a decrease. For example, for assets, draws, and expenses, you would increase them with debits, decrease them with credits. And for liabilities, equity, and revenue, you would do the opposite. And then I have a different way to present the information in case the different way is easier for you. Assets, draws, expenses. The debit side is the plus side. Credit side is the minus side, and vice versa for the other types of accounts. And I did talk about draws specifically in the last video because this is an equity account. So this is the way a lot of textbooks will teach you debits and credits. But if you are doing accounting in practice, in a lot of the softwares, the draws accounts are treated like equity accounts because it is an equity account. So you're going to be posting to the same side. It's just the way you look at the information is going to be a little different. And I will go over some examples of draws, and hopefully by the end of the video, there won't be any confusion. Basically, what I'm going to do at this point is go through several examples. I'm going to show you the example, talk about what is a debit and what is a credit, and show you the journal entry. If you want to follow along, I do have a spreadsheet on my website that you can download for free, and you can fill in the journal entries as I go. So let me show you that real quick. This is on my website. It has a blank journal page, and it has the completed journal on the next page, just so you can go back and reference it later on. So you can download that for free and follow along with me. And this is the first example. The owner invested $5,000 in the business and deposits the money to checking. So two things are affected here. The checking account will be affected, and the owner's equity account would be affected. So the checking account is an asset, and I put that in here, and owner's equity would be an equity account. If they're depositing money into the checking account of the business, that's going to add to checking. So if we're adding to an asset, we can see here that we would debit the checking account. And then we're also adding to equity. If the owner is investing in the business, that is adding to the owner's investment, adding to the owner's equity. So the rule here for equity is you add to that with a credit. This is what it might look like, and I just made up dates, but you would put the debit first, so that would be your checking account. And then underneath that, you would put the credit, and you would put a little space here just to indent it and put the credit amount over here in the credit column. And that's it. That's all there is to it. For the post reference column, I put some account numbers in here. You don't really need this at this point. The main thing I want you to focus on is the debit, the credit, the date, and the amounts over here in the right spot. And then you could put an explanation if you wanted to. I just put something simple. Owner invested $5,000 in the business, but in real life you might have a little more detail like check numbers or something to that effect. Okay, let's go to the next one. In this one, they paid rent of $750. Now, rent can either be prepaid rent or rent expense. Prepaid rent is an asset if they're paying several months of rent in advance, but if they're just paying for the current month, more than likely that's just going to be rent expense. It doesn't say that they paid cash or they paid from the checking account, but you would just assume if it doesn't tell you otherwise, then it's coming from the checking account. Now, a lot of textbooks will use cash instead of checking, but I wanted to make this more realistic for real life, so that's why I put checking. Okay, so if they paid something, that's going to subtract from the checking account. So if we're subtracting from an asset, that would be a credit. And then rent expense, we are adding to an expense account. Now, you may wonder why you would add to an expense account when expenses are something you think of when you're subtracting. You would think that you're subtracting expenses. Expenses do get subtracted on the profit and loss. You take your revenues minus expenses equals your net profits. However, at this point, we are just entering the total expenses into the system so that at the end of the year, we know what the total rent expense was. So at this point, we are adding to the expenses of the business. So you could think of it like that. So when you add to an expense account, you debit. So rent expense will be the debit, checking will be the credit. Okay, so this is what it might look like. You would have the date, and I just made up these dates as I went. Debit would go first, and then the credit would go underneath with a little bit of space here. And then of course you would make sure you put the $750 in the right column. You would want to line up your debit amount with your debit account name, and same thing with the credit. And then you could put a post reference if you have account numbers, and then the explanation was just paid rent of $750. Okay, let's move to the next one. This time they paid $400 for advertising. And again, this is another expense. Keep in mind that expenses are more of things you use up, you have used up, or you're going to use up quickly, whereas assets are more resources. Okay, so this is going to be a very similar entry to the one we just did. You're adding to an expense. Again, we're adding to expenses because we're at this point just getting totals so that we can add them up, and at the end of the year we have the total amount of advertising expense for the year. So we're adding to expenses here and subtracting from checking. So when we subtract from an asset, that's a credit. So credit checking, and debit advertising expense. And this is what that would look like. And again, you could put the post reference, but you don't need to at this point. And then you would put some sort of explanation. The explanation doesn't have to be exactly what I do, just some general statement that advertising was paid for. But the debit account name and the credit account name, these account names have to be exact from the chart of accounts. Okay, let's go to the next one. This time they purchased office supplies of $300. So we're going to be using the checking account. We're just assuming they paid with the checking account. And we're going to use the office supplies account as well. Both of these are assets. Now you might be thinking office supplies is typically an expense, and it is. Many times, office supplies are expensed immediately. However, because I'm teaching you this as if I were teaching you this at a college, I need to teach you this the way a textbook would teach you this. So in a textbook, you would learn that you purchase office supplies and put it in an asset account. And then when we get to the lesson about adjusting entries, I will show you how we transfer what has been used up to expense. Okay, so we have two assets here. We're adding to one asset, subtracting from another. So the one we're adding to would be the debit, and the one we're subtracting from would be the credit. Okay, so we're subtracting from checking because if they're paying for something, that's going to take away from the checking account. They're using up money. The office supplies, we're going to add to office supplies. If they go out and buy office supplies, they're going to buy those supplies, they're going to bring it to the office, they're going to put it in the supply cabinet. So that adds something to the business. That adds supplies to the business. So that is what we're going to be adding to or debiting. So this is what the entry would look like. We put the debit first, and then the credit is underneath with a little bit of space here, and then the amount is over here in the debit and credit column. And then you could put account numbers if you have any, and an explanation. Okay, let's go to the next example. This time they sold services of $1,000 and deposited that money to checking. So first of all, they're going to be adding to the checking account because they're going to take that $1,000 and put it in the bank. That's going to add to checking. They sold services, so they earned revenue. That is going to add to the revenue of the business. To add to the checking account, which is an asset, we would do a debit. To add to a revenue, revenues are up here. Anytime you add to revenue, you do a credit to revenue. So this is what the entry would look like. And then if you wanted to put account numbers, or if you had account numbers, you could put those in there, and then an explanation as well. Now I do want to point out that you can see that I'm doing a debit and a credit in every entry. I went over that in the last video, how you always have to have at least one debit and at least one credit. And your total debits need to equal your total credits. Okay, let's go to the next example. Now they returned $50 of office supplies for a refund. So that's gonna come back to the checking account. They're gonna go to the store, they're gonna get the $50 back, and it's probably gonna go right back in the checking account. And you would be subtracting from the office supplies, because if they sent those supplies back, then that is $50 of supplies they no longer have. So if we're adding to checking, checking would be your debit. We're subtracting from office supplies. Both of those are assets, so we're subtracting from office supplies, that would be the credit. And this is what the entry would look like. So all I did here was basically reverse the first entry. Let me go back. This is the entry for the purchase, and all I did was reverse it for $50. And then you could put account numbers if you have them, and some sort of explanation at the bottom. Okay, let's go to the next one. In this example, they sold $800 of services on account, and when it says on account, just assume on account is either related to an accounts receivable or an accounts payable. In this case, it would be related to an accounts receivable, because if they sold something to a customer and the customer hasn't paid yet, that is an accounts receivable. So accounts receivable is considered an asset. And then of course, this would also be recorded in service revenue. They've earned the revenue regardless of whether they've received the money or not, but they just haven't actually received the money to checking. So this is what the entry would look like. We're debiting to add to accounts receivable. We're adding to the receivables of the business. And we're crediting service revenue because they earned revenue. And anytime you add to revenue, you would do a credit. And then you could put account numbers and an explanation in there as well. Okay, let's go to the next one. In this example, they paid $600 for insurance, which is likely going to be recorded as insurance expense. Sometimes you'll see insurance recorded as prepaid insurance if they're paying for several months in advance. But in this case, we're just going to assume that it's for 1 month because we don't have any other information. And then we're also going to assume that they paid with a checking account because it doesn't really tell us whether they paid with cash or a savings account or what. So the checking account is an asset. We're subtracting from it to pay something, so that would be a credit. And then we're adding to the expenses of the business, adding to insurance expense. When you add to expenses, that would be a debit. And this is what the entry would look like. And of course, you could put the account numbers and the explanation in there also. Okay, let's go to the next one. In this example, they purchased equipment. The equipment cost $3,000, but they made a down payment of $1,000. And I'm just going to assume the checking account since that's what we've been using in this whole video. So the $1,000 would come from the checking account. The checking account is an asset. And when you subtract from an asset, because you would be subtracting from checking if they were paying for something, that would be your credit. And then equipment is an asset account. We're adding an asset to the business. We're adding equipment to the business. So we're going to do a debit to equipment. And then we also have a difference here of $2,000. So if they purchased it for $3,000, they only paid $1,000, they're going to owe money. They're going to have a debt for that other $2,000. And because it doesn't give us any other information, it doesn't say that it's a note, a promissory note with interest or anything like that, I just made the assumption that it was an accounts payable. We're adding a debt to the business, a liability to the business. To add to a liability, you would do a credit. So this is what your entry would look like. And then you could put account numbers if you have them and an explanation. So sometimes you will have more than one debit or more than one credit. As long as your total debits equal your total credits. So I've got $3,000 on the debit side, and if you add the 1 and the 2,000, you get $3,000 on the credit side. Okay, let's go to the next example. This time the owner withdrew $1,000 for personal use. This is going to affect the checking account since we're assuming they withdrew from the checking account. And it's also going to affect the owner draw account. So the checking account is an asset. We're subtracting from checking. That's going to be the credit. For owner draw, you can look at this one of two ways. If you look at a textbook, it will tell you when you add to the draws account, you do a debit. So it's kind of treating it like an expense because we're going to subtract the draws account when we do the reports. The way the book is teaching you is you add to the draws account with a debit. Anytime the owner makes a draw, we're adding to that account so we get a total at year end. And then that total at year end will be subtracted from equity via closing entries, which I will go over in a later lesson. Or you could look at it like draws is an equity account. Equity represents the owner investment, the owner putting money in. If the owner is taking money out of equity, we are subtracting from equity. So it would also be a debit. So it is a debit either way you look at it. This is what the entry would look like. And of course you could put the account numbers and an explanation as well. Okay, let's go to the next example. This time they collected $800 from the customers on account. This is going to affect the checking account and it's going to affect accounts receivable. Let me go back because we had an entry earlier related to this. Okay, so this is the entry. This is the entry from example 7 that we did earlier where they sold the services on account. And we recorded a debit to accounts receivable for $800. And we recorded the revenue of $800. So we don't want to record the revenue again when these customers pay. All we want to show is that these customers no longer owe the $800. They are paying for their bill. So let me go forward. So here, so at this point, when they collect the money, we want to subtract from accounts receivable. It's no longer receivable if the business received the money. So we are subtracting from an asset. That would be a credit. So credit accounts receivable. And then they're going to take the $800 and put it in the business checking account. That will add to the business's money, add to their checking account. So when we add to an asset, we do a debit. So this is what the entry would look like. We would not record the revenue again. We've already recorded that in the first entry. We are just showing here that the money was collected. And then you could put the account numbers and the explanation if you want to. Okay, let's go to the next one. In this example, they paid $230 for utilities. And just like the other examples, we're going to assume that it was paid from checking because no other information was given. Checking is an asset, and we're going to be subtracting from checking to pay something. So it would be a credit to subtract from an asset. And then for utilities, that would be utilities expense. And we're adding to the expenses of the business. So that would be the debit. And this is what the entry would look like. And if you wanted to add account numbers as the post reference and an explanation, you could do that as well. Okay, let's go to the next one. In this example, they sold services of $2,100 and the money was deposited to checking. So this would affect the checking account and they earned service revenue. Checking is an asset. In this case, we're adding money to the checking account. We're adding to an asset. So that would be a debit. You would also add to revenue. To add to revenue, that would be a credit to revenue. And this is what the entry would look like. And you could add the account numbers if you have some and an explanation. Okay, let's go to the next one. In this example, they paid $500 towards the equipment debt. So this is going to affect the checking account and it's going to affect a liability account of accounts payable. Let's go back to that previous situation so we can look at the original entry. Okay, this is the entry that we're looking at here. There was an accounts payable recorded in this example where they purchased equipment for $3,000 with a down payment of $1,000, and then for the other $2,000 difference, an accounts payable or a liability was recorded. So when you add to a liability, when you add to the debt of the business, it would fall under this rule where you would credit to add. Well, now they're making a payment towards this accounts payable. So we're going to do the opposite. We're going to subtract from a liability. So let me go back to that. We are subtracting from the checking account because they're paying something, and we're subtracting from a liability because the debt is reducing. So it would be a debit to accounts payable to subtract from a liability and a credit to checking to subtract from an asset. And then you would add in the account numbers and an explanation if you wanted to. Okay, let's go to the next one. In this example, they paid employee salaries, and salary entries, payroll entries can get fairly complicated. I do have some other videos about payroll journal entries that you could watch as well, but in this one, I wanted to keep it fairly simple for a payroll journal entry. In this example, there will be 4 accounts affected. First of all, the checking account for the net pay. So the business will be paying something, money will be subtracted from checking, Checking is an asset, so we're going to do a credit to checking for the net pay. And then they also have salaries expense. The expense of the business will be the gross pay of the employee. And when we add to expenses, those are debits. Payroll tax expense, that would be any employer taxes that the employer or the business has to pay. That is just another expense. So it will be similar to salaries expense, although it'll probably be a much smaller number. We would be debiting payroll tax expense for any employer taxes. And then any withholdings for the employee. In this case, I'm just going to keep it super simple and just put it all in payroll liabilities. This is a liability account, and what we're doing is showing that the taxes withheld on the employee paychecks and the employer taxes that the employer has to pay, all of that is going to be sent to any government agencies, any tax agencies. So for this entry, just to keep it simple, I'm going to put it all in payroll liabilities. This is going to show that the business owes this money to those tax authorities. So this is what the full entry would look like. You would debit salaries expense for the gross pay, debit payroll tax expense for those employer taxes. Checking would be a credit for the net pay, and then any withholdings and the payroll taxes, those would be a credit to payroll liabilities. When you add to liabilities, that would be a credit. And then you could add any account numbers and an explanation if you wanted to. This was the last example I had for today. What I'm going to do in the next lesson is I'm going to show you how to post all of these debits and credits to the ledger. So be sure to watch for that video. If you have any questions, please feel free to comment below, and thank you for watching.